Welcome everyone to the Multifamily Deal Structuring Monday. Today our guest is Jason Pero. Jason Pero and Nadia Shabanza Pero formed their real estate business in 2001 when they acquired their first duplex. Upon graduation from Westminster College in 1999, Jason worked in a pharmaceutical and subsequently medical device sales until 2012 when he quit the corporate job to run their real estate company. Nadia worked in pharmaceutical sales after graduating Mercyhurst University from 2002 to 2010. Both Jason and Nadia gained valuable corporate management and sales training during their tenures with the various medical companies they worked for. From 2001 to 2004, they acquired a few units per year, growing their portfolio to 23 units. In 2005, their first large acquisition, a 56-unit multi-site portfolio, launched their real estate investment career to the next level. Over the next several years, they capitalized on the housing downturn, acquiring many smaller distressed investment properties and rehabbing them and rolling them into their portfolio. When Jason left his job in 2012, the business had grown to 290 units and several employees. Their business is a source of a great pride. As of December 2020, they own over 1,100 rental units in the Erie and Edinburgh, Pennsylvania, as well as Cleveland, Ohio markets. Jason is a president of the Apartment Association of Northwestern Pennsylvania and has served as a board member for over 12 years. Nadia is a co-owner of a local home staging and interior design business. Here's the interview. Hi, Jason. Welcome to the Multifamily Deal Structuring Monday, where we will discuss all about your first GP transaction or one of your early deals. Thank you for joining us here in the show.
All right. Thanks for having me, Jefferson. It's great to be here.
Yeah. So let's start with, if you tell us about yourself.
Okay. Jason Pero, born and raised in Erie, Pennsylvania. I've been investing in real estate for 20 years, almost 20 years. My wife and I started out buying small properties like duplexes, single family homes, quads. Currently have over 1,000 units in ownership. Half of that we own ourselves with no partners, and half of that we've syndicated as the general partner key sponsor. So we've done kind of a wide variety of things in our time in multifamily real estate.
Okay, that's awesome. So at least you mentioned you have a single family because before jumping to the multi.
Yeah. We spent a lot of time when we were buying. We would come across a 10-unit, a 20-unit, 50-unit deal, and then I would just always be looking for deals. So there's a time where we'd spend a lot of time just buying up smaller properties, or maybe it was close to other properties we owned, so we would just buy a lot of small properties as well.
Mm-hmm. Okay, that's good. Where are you currently located?
Erie, Pennsylvania. So it's about equidistant from Buffalo, Pittsburgh, and Cleveland. So it's only about an hour and 20 minutes from each of those cities.
Okay. Yeah. What factor did it for you to end up in multifamily?
Well, as multifamily as opposed to smaller properties, or just real estate in general?
Real estate in general. Why multifamily?
So when we started buying property, I'm 43 now. We're fresh out of college. Really didn't know much about making money, building wealth, that type of thing. But reading different books, talking to different people, some different internships that I had in college, kind of led me to this path that real estate really seemed like the vehicle to build wealth. And that was, not that I was poor, but I certainly wasn't rich, and came out of school with a mountain of student debt. My parents never really had money, didn't ever teach us about money. So I thought, hey, real estate seemed to be the angle. And so, it was just always that goal to keep, when we were starting out, we didn't know any better. So we just used all of our own money, funded our own deals for the longest time, and really didn't get into the larger syndications until the last few years. So really what drove getting into the syndications was just, a couple things. I mean, one was just an evolution of trying to simplify. I mean, I always caution people, you shouldn't get into real estate to create yourself another job. If you're doing this for freedom, freedom doesn't mean, I guess you're free to work 80 or 90 hours a week, but once you've got this thing cooking, you shouldn't have to work that crazy grind anymore. So really it was just an evolution of trying to get into bigger properties, mean bigger profits. Really enjoy providing value to passive investors. So, having something that people can, they can look at, feel proud and trust, that they own it, trust us. We self-manage, so we're vertically integrated, and so they can be proud that they own it, but also provide them with a very healthy dividends and nice equity growth. So that's a really satisfying piece for us is helping investors help them achieve their goals.
Yeah, I think that's good. And also, I think to our listeners too, I know, it is probably okay to grind it, but at some point you need to plan ahead that you're not getting another job, as Jason said, because or else like then you instead of working for a boss, you're the boss, but you're still working.
Yep.
So better plan with on the passive side that you're setting it yourself up in like multiple doors, not just small units. So the multifamily is a good entry. I mean, at least good way to achieve that goal. Yeah. So the next question is any limiting belief that you have and how you were able to overcome it to get to your first deal, multifamily, at least the commercial space.
I think when I kind of got into the the larger multifamily stuff, we had done some things on our own, but one of the biggest limiting beliefs was just the ability to raise money. We had done private investments, hard money loans, all these kinds of things, but really having that self-confidence to be able to go out and raise money. And the first time you do it, it's scary, and it's hard. So I just think, and I still battle this, and I know a lot of people do. A great deal comes across your desk, and you're like, well, man, can I raise this much money? Am I going to be able to get this done? And that's definitely a limiting belief. And I know I'm not the only one that suffers from that, because you might look at a great deal and you're like, oh man, I have to raise 3 million, 4 million, 5 million, whatever it is. And you question and doubt yourself, like, oh, can I really get this done? And I think that's just something you have to battle through, and the confidence comes with experience. It comes with doing it. So you really push beyond and take that risk, really push yourself to have that confidence that you can get it done.
Yeah. I think I think me myself also, like the raising capital piece also is the limiting belief that can I really raise it or something. Yeah. Okay, then let's jump to your first deal in multifamily. What's the source of that deal?
So source of that deal was a broker relationship. I'll just clarify for your listeners and viewers that this was our first syndication that we're talking about. So that came from a broker built, over the period of time in our real estate career, just built a lot of relationships with brokers, realtors, just anybody that would. I mean, not every. We're not like trying to network with every single one out there, but you just become friends with brokers in the business, and they brought us a deal that the sellers were a couple that they had been divorced. They were actually still running the real estate portfolio together, but they had I think now they're in their mid or late 60s. So they had real estate. I mean, they're kind of a different story. They had, the one spouse had inherited a lot from being, their family's been in real estate for 140 years. It's a crazy setup, but this is stuff they bought together and during their marriage. And so this was like the first piece for them to drop, and we've subsequently bought a number of most of their properties that they had during their marriage together, but they've been divorced for several years. They're still, very amicable, and they still are, and they run their business together, but had some family issues, had some other things, and they just decided that we're going to retire and kind of cash out and go about our lives.
Mm-hmm. Okay. Then where's this located? This first deal?
Erie, Pennsylvania. So all of our all of our properties until very recently were located in Erie. We've just gotten into the Cleveland market recently.
Okay, very nice. Then what's the number of units for this?
That was an 86 unit property.
86. Then what class is it?
Class B.
Class B. Okay. Then I think you mentioned already the story of the property. For that T12 and rent roll, was there any kind of something that stands out when you were reviewing the T12 and rent roll?
Yeah, there's nothing of overly concern us. The one issue they had run into some small hiccups along the way. They were located right next to a larger 700 unit property that had a history, several years of just like terrible management, terrible disruption. And that affected their property for a while, but not terribly. I mean, it wasn't anything that jumped out that that I said, oh wow, this is really affecting it. So that was always the question when we were evaluating the deal: is that, hey, there's this neighboring property, is that going to have some spillover to our property? And we were able to kind of go back. They gave us like 6 or 7 years of data, so we were able to look at the trends and look at things, and nothing jumped out that scared us.
Okay, then that's good. Then, yeah, what was the original asking price on this property?
Yeah, original asking price was 4.5 million.
4.5. Then, how much were you able to get it?
We got it for 4.1. Reason being there was it was just a couple things in the appraisal process, and we were just able, we didn't really retrade the deal, but there was just some pieces that we negotiated to get a little bit lower of a price.
Okay, then, yeah, when you purchase it, like, what's the economic occupancy of the property?
So that property was 96-97% economically occupied. It was run really well. This couple, they're very professional about how they ran their business, and it was really more of a turnkey situation at the time, or that's how we viewed it when we bought it. But
Okay,
things change.
yeah. Yeah, then, for the financing breakdown on this, like, is this a Fannie Mae agency loan or?
It is, yeah. So
Okay.
it's a Fannie Mae loan. They did a 80% loan to value. So we raised the difference from limited partners.
Okay, then, yeah, so 80% of the purchase price is the loan amount. Then what's your CapEx budget on this?
Well, that's where we really made a mistake. So we were so eager. My wife and I partnered up with another local business person. I become friends with him, and he had some real estate, like condos and condominiums in Florida, and that he had syndicated like 10 years ago. And we knew that we wanted to do something together. We're so eager to get this deal done. We over raised on our capital raise. And so instead of setting that money aside for CapEx, we turned around and bought a handful of townhomes from the owners of that property, which I don't necessarily regret doing, but we didn't. We were just so eager and blinded by, hey, this is our first deal, that 3 years later, this summer we had to replace almost 15 air conditioning units, at $4,000 a piece, and we had some other issues that came up, and so that was a misfire on our part. But I think the thing is, with every multifamily deal you do and you syndicate, you learn the hard lessons, you get better, and you realize, like, man, I should really listen to the experts. I should really be better at certain areas, because when you're dealing with investors, it's one thing if it's just you and that's it. It doesn't matter. You're only risking your own money. But when you have investors, you have to be, I think, just much more dialed in. So we've refined our approach, and now we always have a CapEx budget, even if we don't need it. And that was a little bit of a learning experience. Unfortunately, our investors are very understanding. It's still a great asset. We only, we distributed it every quarter, and actually over distributed for a period of time. So overall, it's gone really well. But then we hit this hiccup during COVID where we're like, oh crap, we didn't budget for these things, and we have like some major capital expenditures we have to do. So it's part of the game, but that's a big lesson to like, don't ever skimp on that, on that CapEx budget.
Oh yeah, for sure. Then, yeah, and also I think some people also was having, especially during COVID, like, those that didn't have reserves, and the payment went down. So those are the ones that kind of having problems right now. Yeah, definitely, for sure. Like, you should have at least some rainy day fund.
Yeah, absolutely.
Yeah. Then, for this financing, how much was the interest, if you recall?
It was at that time. It was in the fours. Maybe mid fours. I can't recall the exact interest rate, but it might have been 4.5 or 4.6. Which 3 years ago was great. I mean, that was a
Oh
great
yeah, right
interest
now
rate
it's
3 years ago. Yeah.
yeah. Then they said, and then also what's the loan terms? How many years did
Yeah,
you
it's fixed for 10 years. It's a 30-year. I'm sorry, fixed for 12 years. We did a 12-year fixed, 30-year amortization. So we have yield maintenance for 10 years. So at year 10, we can sell or we can refinance and depending on what we want to do. But we have, we the term of the loan is 12.
Okay, okay. So battery is you have at least 10.
Yeah.
Then for what's the investor split that you structured on this one?
Well, this is another mistake we made. So the first deal we did, it was so eager to get this deal done. We did a 90-10 split, which was
Wow.
terrible, So
Yeah.
here's this property that it was a lot of heavy work. But you learn. And so every one of our subsequent deals, it's always been deal dependent. So on average, we're between 80-20 and 70-30. So it depends on the deal, the risk, the amount of work that's going to go into it. We want to make sure that we provide a solid, predictable return to our investors, but also that as general partners that we're compensated for our efforts.
Mm-hmm. Yeah. So this is a 90-10. Is there any pref or is it just straight split?
Straight split.
Straight split. Okay. Then what's your business plan when you bought this one?
Well, that one, we just really looked at it as a turnkey property. We budgeted for annual capex stuff. There's no upfront plan, but it's a great location in the suburb of Erie. So we have the largest medical school in the country is in our town. So we had a lot of medical students, and we could draw a lot of people that like the school district. It's one of the better school districts in our area. So for us, it was really a turnkey, looked at it as a turnkey, predictable sort of investment. So there was no heavy lift involved. All we had to do was market it a little bit, didn't have to really overly market, just enough didn't have to compete with that neighboring property that was turning itself around, just be in the conversation. So that neighboring property that I mentioned that had 700 units, when the current ownership got that, it only had 100 occupied units. So you think about it, they had to fill 600 units, and it was unbelievable. So they were pretty much giving away apartments. Now ours were a little bit better in terms of quality, but very very similar location. And actually, they were built by the same builder 45 years ago. A lot of same layouts and things like that, but the one we purchased was better maintained. It had been taken care of and updated over the years. So we felt like, hey, we could be a step above, would be a lot easier to manage. So really, it was having a marketing plan that we could be in the conversation, and not necessarily to compete, but just be in that conversation with that neighboring property. Mm-hmm. And overall, it's been really good. I mean, like I said, there's been some hiccups, that have been some lessons we've learned, but overall, we can, we're doing pretty well with it.
Okay, yeah, or probably maybe you can ask find out who's the owner of that 700 units.
Well, yeah, I know.
Try to buy, right?
Yeah, we've talked to the owner quite a bit, and they're out of town, an out of town group. My only, every market's different, but in our market, it's not a huge MSA. It's an MSA of about 270,000 people, and a 700 unit apartment complex to me feels well, and it's only because we self-manage. That would be a really difficult management task, especially on improving the property. So it just felt like a little too big that it could easily get out of control. And I'm sure there's I may change my tune on that at some point if it becomes available. But at some point they're going to want to exit or bring in other partners. There were some Wall Street guys with some Wall Street money that purchased that. They basically purchased the loan for relatively next to nothing. So they got a great deal, but it was a lot of, still is a lot of work. I think they're still working really hard several years in trying to improve that asset.
Yep. Then so regarding that returns for your investor. So what's the IRR and the average cash on cash on this?
So the average cash on cash is 8%. That's what we that's kind of the baseline of what we try to provide for our investors. Then the IRR is about a 15-16% IRR, just based on the debt pay down and the appreciation. It's not a killer deal, but it wasn't designed to be. It wasn't a heavy lift. It was just pretty much a straightforward turnkey kind of operation.
Okay, sounds good. Then let's go to the next section of the show where I asked about the due diligence. Like,
Mhm.
yeah, and what the kinds of due diligence that you or your partners have done on this
Yeah.
property?
So that property, again, it's speaking about the first one. It wasn't. We learned that now we walk every unit. We make sure that, and because we self-manage, I'll typically have some of my staff on that due diligence team. So we will have a uniform inspection sheet. One of my partners created a Google Sheet inspection form that, so like if we're, recently we were acquiring a 104 unit in Cleveland. So everybody on the due diligence team had the same form and they could fill it out uniformly. And so then we could collect all the data, because we couldn't, we weren't all walking every single unit together. So kind of divided and conquered the tasks. So we'd walk all the units. We would have generally a structural engineer. We look at the, especially if flat roofs, we get roof inspections, boiler inspections, sewer line inspections, and try to make sure that we're more thorough than we need to be. Because again, when you're dealing with investor money, you don't want any surprises. I mean, God forbid, you need to replace 6 roofs in 2 years and you didn't budget for it. Well, then you have to go back and explain to your investors where you screwed up and what you're doing to make it right. So for me, it's better to spend a little bit more time and money on the due diligence side. So that's the physical due diligence. Like I said, we go through everything, then come up with a plan. I mean, there may be nothing we have to do, or it may be a really heavy lift. So coming up with a plan, having that budget really dialed in. And then we do, in terms of a lease audit, we generally don't go through every lease. I mean, we'll look at, for instance, if it's a portfolio, we'll look at, a handful of unit leases per building. And as long as they match up to the rent roll and the data, we keep going. But if all of a sudden you start seeing anomalies and things aren't matching up, then we dig deeper, and then we dig deeper. And so ultimately you could go through every lease, but we start out by, just kind of randomly picking a number of units per building. And then we look at and review every service contract. Again, been burnt on that before, where you take over a property and don't realize that you're locked into a long-term contract with some other type of provider, and that can be painful, from whether the service they provide or having to financially buy your way out of that contract. So we try to just review everything we can, during that due diligence period.
Okay. Yeah. Then for the due diligence, so let's say the lease audit, how long did it take for the lease audit? Let's say for this 86 unit.
For the lease audit?
Yes.
Just maybe a few hours. I mean, there was our CFO and myself will usually go through it, or I'll have somebody that's either on the GP team, or an employee do the audits and kind of do everything. So the lease audit's not a big deal. Doesn't take that long to do. The physical, sometimes we'll go into a few days, but we, depending on the size of the project, try to knock that out. At least the actual tours and everything within a few days. If we're hiring third parties, they can kind of do that at their own leisure. But if you have a 2 week, for us, that 2 or 3 week due diligence period, starts upon when they provide all of the information to us. So we've got to hurry up and be quick, so that if there is anything we need to, if we need to walk from the deal or ask for some concessions or renegotiate, we've got all the data we need in as quick amount of time as possible.
Yes. Yeah. Then. Yeah, and also when you're walking through for the physical due diligence, right? So you're walking with your contractor right away on that spot. Okay.
Yep.
Then so at least the contractor will know how to estimate. Then you just, I guess, meet again after the full inspection, saying like, okay, what do we need to do and how much will it cost? Yeah. Okay.
Yeah. And again, we self-manage, so having a crew of maintenance personnel, contractors we deal with, we can make those calls and we can make those estimates pretty quickly too.
Okay. I guess, yeah, that's a good point. Like for vertically integrated, vertically integrated means like for our listeners means they own their own management company and stuff. Then, so if you're doing this maybe with a third party, so you need to make sure like your schedule is with schedule with all your third parties, because I don't think like you will have a like the full, let's say, give you 1 or 2 months just for physical due diligence. I mean, the seller will not give you
No.
that long time. So better schedule ahead of time.
Mhm.
Yeah. Then going next for the capital raise, how much capital you need to raise for this deal?
So the first one we did, we raised about 1.5 million. We only needed about 1.2 that we raised. So we overraised, and like I mentioned, instead of putting that into the property, we bought a handful more townhomes, but wasn't, I wouldn't change a thing. I would have just budgeted a lot better for the capex.
Okay. Yep. Then yeah, do you recall like how many investors participated?
Yeah, that was about a dozen.
Okay, 12.
Yeah.
Okay.
Yeah.
And what's the typical average for per investor?
The average age.
Yeah, average.
Yeah, so it really varies. I mean, we've got, our average age is probably early mid 50s. And so, we've got some investors who are older and they're retired, and we have some that are just young, high income earners that want to diversify their portfolio. So really varies.
Okay. About the amount, how much was the
Okay.
average?
Yeah. The average amount on that deal was, that one was about 150,000 per. And we had some people that came in at 50,000, and we had a couple people that were in at 200,000. So it averaged out to maybe about not quite 150, maybe 125, 130 on that first deal. And I think our average, every deal is a little different. Like this Cleveland deal we're doing, the average investment's $500,000.
Wow.
We have the highest amounts, 700,000, or excuse me, $1 million. We've got a few at a couple 100,000, and then, a few in the upper six figures. So it really just varies on the type of deal.
Mm-hmm. Then this, the one who is investing, is this like a private person, or is it like an equity? The one who's contributing this 700 or the seven figures.
Yeah, no, it's an individual. So they actually had a 1031 exchange they needed to do. So it was, so we had to do a TIC structure, a tenant in common structure, which, we'd always heard about, and we're up for the challenge. I mean, it just creates another layer of complexity in terms of structuring the deal. But, there's a lot of people out there that are doing 1031 exchanges, looking for, a new place to park their capital and to earn a good return.
Mm-hmm. Okay. Yeah. Then, so the next segment is the closing. Around how much do you recall, like how was the closing cost for the deal?
Closing costs were, well, we had a point that went to the lender. No, I couldn't tell. I mean, it was a few $100,000 when it was all said and done. So maybe, maybe it was a less than 1% of the overall cost of the deal. So, or I mean, it was a few percent. I'm sorry. So, but attorney's fees and lenders fees and things. It wasn't crazy, but the transfer taxes, it's 2% in our area. So 1% is from the seller side, 1% on the owner side. So, so we had $40,000 just in transfer taxes.
Mm-hmm. Yeah. Well, yeah, I guess that's a good point. Like, because sometimes all these closing costs, even like it's a small percentage, but if you're talking about $1 million in purchase, this can go a little big.
Yeah.
So you need to take that into account. Yeah, because I know like state by state or city by city, like this transfer tax varies. Then if you have a huge amount of transfer tax, you need to make sure you put that into your budget.
Correct. Yeah.
Yep. Then for the closing, how long did it take for LOI to closing or PSA to closing on this?
Sure. It was about, it was under 90 days. It was about 75 or 80 days. And that was another lesson I learned in the process was I always bake in extensions. The seller, we're dealing with Fannie Mae. I mean, there's several moving parts to the deal, and we had the property under contract at the end of August that year, and as we got to the end of October, which was 60 days, the seller was really putting an inordinate amount of pressure on us, and I said, well, we need to extend, and she's like, well, give me another $50,000 and I'll extend you a week. I'm like, well, we need 3 weeks, and it wasn't a matter of if it was going to close, it was a matter of when it was going to close. And that was made for some very stressful and uncomfortable conversations. So from that point forward, we typically write 60 to 75 days in the contract. And then we always have the ability to buy a 30-day extension with just additional hard money. And a lot of times that, especially during COVID, that happens because there's always going to be delays and something that might be out of your control.
Yes, yeah. I think that's a good point. Like I have this discussion in the past episode as well. For everyone, like the listeners, you really want to put some clause on your PSA saying that you have the option to extend it at some number of days or something. Either it's up to you and the seller if they need more money for us. That will be hard. Then hard means like it's non-refundable.
Right.
So you need to put it because it's better, I think, in every transaction, right? It's better to discuss it upfront rather than after the fact that it's happening.
Right.
So better prepare the seller so that when you're now on that the time that you need to extend, it's not a surprise. So we already discussed this upfront. So and things might happen out of our control because of especially this lending, like it keeps on changing depending on what's happening, especially during COVID. So yep,
exactly.
Better put it. Okay, we reached the last section of the show where I ask every guest for the final 5 sizzling questions. So number 1 is any lessons learned that you want to share from deal analysis, due diligence, capital raise, financing, closing as an experience. I know like you might have a lot of lessons learned here.
Sure. Well, I'll recap a couple of things I said. Number 1 would be the limiting belief that, one of the things that stands in a lot of our way in doing these deals is just our own mental process about being confident enough that we can raise the money. And so just knowing that if you have a good deal, there's going to be plenty of money out there for your deal. So having that self-confidence and you have to have a little bit of faith and take that risk. But that's just a big limiting belief. Always plan for the unexpected. So have your reserves, plan for CapEx, and do a thorough due diligence. So don't skimp on those things, because I will tell you, if you don't if you do them, then you can rest well at night knowing what you're facing with that property. If you don't do it, you're going to continually be surprised at the stuff that comes up that you could have prevented or at least anticipated and planned for.
Yes, for sure. Then the second question is any recommended books?
Yeah. So a couple books. If somebody's looking to leave their day job, and this popped in my head because a friend of mine who's leaving his job had asked for some recommendations the other day, and one was No More Mondays by Dan Miller. I think he has an update to that called No More Dreaded Mondays. But that's a great book, for people that are looking to leave the 9 to 5 and kind of be, create that entrepreneurial, vision of their career that they want. Another one would be Zen and the Art of Making a Living by Lawrence Bolt. And that, it's just kind of deeper, just very practical approach on, what it is you want to do with your life. But it's, ask some of those more existential, deep questions that, if you're going to be an entrepreneur and you want this freedom, why, and what are you going to do with it? So that's a great book. And the last one I'll leave you with is The Compound Effect by Darren Hardy. That's probably the most gifted book that I give away and I recommend all the time. It just speaks to the power of, we can think about massive action, and sometimes, nothing's going to happen without you taking action. But a lot of times the big results and these big shifts don't occur overnight. They're a result of the small incremental things that you can do every day. So, becoming a master investor in multifamily, you're not just going to wake up and do that. It's these small little things every day. So whether you think about becoming 1% better each day or making some small decision that's going to get you closer to your end goal, but you're not going to, if your goal is to own 1,000 units, you're not going to get there overnight. So you have to just take steps to, take those steps to get those little seemingly small decisions are what makes the biggest difference at the end of the day.
Yep. Yeah. I agree on that. And also, I think to everyone listening is, even if it's how small the step is, like a very, very small step, but at least you're getting towards your goal. So it doesn't matter because it will take time to reach your goal. So it's not like an overnight, as Jason said. Yes. Then number three question is any recommended podcast or YouTube channel that you're listening to and would recommend?
Yeah. I always recommend Rod Cleef's podcast, Lifetime Cash Flow.
Oh yes.
I think just, Rod is, I've been blessed to call him a friend. I'm part of his mastermind group and do some coaching for him, and have been lucky enough to be on stage at a few of his live events. But Rod's just one of these people. It's not just trying to sell you something. It's all about mindset. He's got close to I think 500 episodes now, so a ridiculous amount of just really positive people that want to help. And so I think that I can't say enough positive things about his podcast. And then outside of real estate, because there's a million real estate podcasts, and I love to name them all, but and I've been on a number of them, and I know I think what I would recommend in terms of real estate podcasts is listen to a variety of them and see who you really resonate with, because every host style is a little bit different. And so when I recommend Rod, I think Rod is great for everybody. There's something for everyone there, but there's a lot of podcasts, a lot of YouTube channels that just have just a little bit different approach for different people. And of course, I'll recommend yours because we're here right now, so everybody should listen to your YouTube channel and podcast. But I think for the non real estate stuff, I just love the Tim Ferriss podcast, and I love the Joe Rogan podcast, and only because you get these really interesting interviews with that show different perspectives and different sides of various issues, and they're both different in their own ways, but those guys are masters at their craft, and I just think there's a lot to learn from them and their guests. So I can't listen to every single one of them, but I usually catch one or two of their podcasts a week as well.
Yeah. I second also the Radcliffe. Like I think I almost already heard like all of most of them probably because when I started, because I tried to drain as much as podcasts or that I can consume, especially before COVID, when I was like, it's a long bus ride for me to work. So I make it a point that I have my earbuds.
Nice.
Then listening to all this to and from, to work and from work. Yeah. That's the way you will learn. Yeah.
Exactly.
Yeah. Then the fourth question. So this is the time to promote yourself. What's your acquisition criteria for multifamily in terms of location, number of units, class? Yeah.
Sure. So we like B and C assets. I like A assets, but generally we're looking at B and C assets that have some meat on the bone. They have some upside, that either through value add from physical upgrades or from management upgrades. We self-managed for 20 years almost, so we know what it takes to manage these things well, and we don't always get it right, but we do our best. But so I always look for a little bit of upside. I prefer secondary and tertiary markets, and the reason being, it's like Murphy's Law. Like I know that if I jump into that hot market, I just feel like I'm going to be the one stuck holding the bag, that everybody's had this massive appreciation, that I'm the one stuck. So I generally like the markets that are very predictable. So Erie, Pennsylvania, Cleveland, Ohio, Pittsburgh, people generally don't think of those as like, these hot markets. But what's great about those is that you can buy an asset in any of those markets, and with pretty good precision, be able to model out what those returns look like. And you look at it during COVID and say, how are those multifamily operators and properties doing? What are collections like during COVID, during a 2008? And, we've invested through a couple different market cycles. And I look at those types of markets and I say, hey, they're not going to experience the huge boom, but they generally aren't going to bust. And so, there's always those exceptions, but that generally is going to mean long-term stability. So even if you overpay for something or think you overpay for something in one of those markets today, you're still going to have reasonable appreciation over a long period of time, 5, maybe 10, 15 years. But I like the idea that there's, we're hedging our risk by investing in markets like that.
Mm-hmm. Yeah. I agree on also on that one, because it's sometimes you don't know if that particular market is already on the top, right? That if it's too hot, that you need to really see like if it's already saturated, and the absorption. So absorption, you really need to take a look like how long does it take for, if it becomes vacant, how long does it take to put a renter there.
Exactly.
So be careful for those who is buying like in a hot market.
Yeah. And one point too, to a value add strategy or even just looking at a property, I always, I try to tell any conversation we're having or folks I've mentored along the way. I think that for me, and this is just my criteria, I mean, everybody has a different risk tolerance, but I like to think that worst case scenario, the deal should still cover, should still cover everything, cover its debt, cover its operating expenses day one. The upside should be from that value add, but I don't want to have to get into a deal that's 1 or 2 years of interest only, and then all of a sudden that this converts to a full principal and interest, and you can't get the rents that you projected. So I think it's one thing to misfire on your projections, but you're still able to make your obligations. You're still able to deliver some sort of return to your investors. But God forbid you can't meet because you were too aggressive with your assumptions. So to me, I think my stress test, I should really have a solid stress test on the property. I should be able to cover, just from a basic math standpoint, we should be able to cover our debt and core operating expenses. If we don't, have this, huge value add that we were planning on.
Mm-hmm. Yeah, that's I think a lot of people are also there depending on the interest only, and you just need to make sure that even let's say without an interest only, will you be able still to perform? Let's say as you said, like you cannot reach the rent, or for some reason that something came up and now you're kind of sidetracked to your renovation, and now you need to fix some of like maybe the HVAC got broken or something else.
Yep, exactly.
Yeah. Then so the last question, what's the best way to contact you?
Yeah, so if you want to put it in the show notes, but I'll let you know. Anybody can reach out to me on if they want to schedule a strategy session. You can hit me up on Calendly/JasonPero. Connect with me on Facebook, LinkedIn. Hit me up on email, just jasonpero@yahoo.com. And happy to jump on a phone call or trade messages. And whether you're just looking for to bounce some ideas off of somebody, I can give you unbiased opinion. Or if you just want to talk strategy and connect further, I'm here to help any way that I can.
Okay. Yeah, I'll put Jason's contact information and also his acquisition criteria in the show notes, and including the books and podcasts. So everything will be in the show notes for everyone to review. Yep. And we reached the end of the show. Thanks a lot, Jason, for your time. I appreciate it.
Yeah, thanks for having me. I really enjoyed it.
All right, thanks.